Hey everyone, hopefully you're having a good day. My name's Andy. My channel's Finding Value. I was reading through the comment section, want to kind of respond to some of your guys' comments, give you my opinion. Um, so let's go in here. I'll read a couple of these. It says, I forget what the proper action is when theory and practice diverge. Well, nothing's diverged. Markets go up and down. It's the way that markets behave. And some of them, you've got some people who've studied it, Elliott wave theory and all this other theories, where you get moves up and then it pulls on back. It's still very hard to read because as you zoom in, the patterns are the same as you zoom out. So really, you don't know where things start and stop. Some people pretend they know, and sometimes there's obviously people who know this very well, and then there's others that pretend that they know it. I don't pretend to know it. I mean, I kind of use it, kind of don't. I don't know if I apply it correctly, and that's why I'm hesitant to really dive in and show everyone what I know of it. But if the market conditions are good and the valuations are good, then I just hold on. That's how I drastically reduce risk of missing what would be the best opportunities that someone can have with the highest probabilities. And I was kind of thinking about some things. And so some of the things I was thinking about is, how to tell value, which is ratios. And that's what I came up with. And, you've got benchmarking and doing comparative analysis in real estate, where they take the same size house, the similar size yards in a similar area and similar, and then you compare the price of what that sold for versus the house that you have or whatever it is. Everything is just basically, it's all comparative and relative to the time that you're in. So you're comparing prices at the same relative time, or a time frame that is what people would consider to be relevant. And that's all you're doing with ratios and assets. But one thing I was kind of thinking of is, why do markets go down when you have a very good market deficit, a good thesis, good fundamentals, but you're still having to interact with human beings, and human beings may or may not be rational human beings. And most of the time, they're not rational, and the markets are not efficient. I would say that the majority of time, markets are not that efficient, because when you think of market efficiency, really you're just herding cattle at that point, right? It's just where the cattle's going and where the herd's going. And all you're doing is you're front running the herd. That's all we're trying to do, is front run the herd. And all of these metrics, when you look at it from how does someone make money? Just how does someone make purchasing power gains? Not making money, but purchasing power gains. You have to front run the herd continually. You have to buy it before the herd gets there. Then you buy over here, the herd gets there. And however that herd reacts to news, however it reacts to short-term things, is what that thing will do in the short term. And then I got to thinking about, you've got a commodity boom. And a commodity boom, if we've noticed, and you look at the price charts of all these different things, they're all going up a lot at the same time. That doesn't mean that every commodity is short. It's not driven by supply and demand of that commodity. It can't be. How can you have all of these different commodities all go up at the same exact time? So then there's got to be a greater force that is driving it. And that's where I came up with the real estate cycle, and that the real estate cycle was the driver of commodity booms. It has nothing to do with supply and demand. What it has everything to do with is the market conditions and basically guiding the herd to other assets under different market conditions. And what I think guides that herd is higher inflation, which then pulls the interest rates up. And those interest rates start messing with bonds and stocks and causes that rotation. And vice versa, when you hit the other side, when rates get lowered and inflation is low, money wants to rotate back out. That has to be the truth from what I can gather, because you can't have all commodities all have a commodity boom at the same time. It's not driven by supply and demand of those individual commodities. It must be driven by the values that are given. So it's a ratio, because you have a commodity priced in dollars, and the dollar, that value, and inflation is what's driving the valuations of the entire commodity complex. And obviously, there can be supply and demand increases during those time frames, and it makes sense, because if a country were to, let's say China or whoever it is, doesn't matter, and let's say they have to transact in dollars. If the dollar is losing value and you've got increasing interest rates where bonds are not attractive to invest in, neither is the stock market that currency is denominated in, it means that they would probably start doing projects in commodities, because it's better to do that than to lose your money in other things. So they would invest more. More countries would invest more in infrastructure projects at the beginning of a commodity boom. So people would then think, oh, well, it's a supply-demand issue. Well, is it really, though? If they don't have an option to invest in bonds because it's going to lose them money, real purchasing power money, it's one, in a negative real rate, and two, you've got an increasing interest rate, which is you're going to lose money because those bonds are going to get discounted lower. And then you've got stocks, and if you've got a dollar that's going down in that type of environment, then the market conditions, those conditions, are driving the demand of commodities, because your demand may go up of all certain different types of commodities, not because of a commodity, not because of a boom by any sort of means that everyone decided to do it at the same time, but a boom because of the market conditions leading them to invest in those types of investments because they can't make money somewhere else. It's kind of like the last place that you have to go. So I was just thinking about all this stuff, and how having large pullbacks in the middle of commodity booms in commodities, and how they can still happen, and the fluctuations and all this stuff, and how producers, usually the big producers, they usually underperform, and then the smaller guys usually outperform, which is just a flow of money. There's no rhyme or reason. And when you look at like the fundamentals of the company, the actual cash flow and money making prospects of the company, you buy commodity companies when that looks the worst, and you sell them when they look the best. Seems quite backward, right? And people always say high prices cure high prices. I disagree. I don't think that's the actual case. Because high prices only exist under certain market conditions. High prices don't cure high prices. Market conditions cure high prices. Is that a true statement? Do interest rates or the market conditions changing is what cured the high price? The deleveraging event. If we still have a leveraging up, the high price remains. It still exists. Those market conditions and the prices will continue to go higher. Look at the 1970s, look at the 1960s and 50s and 40s. That was an entire large real estate boom of new houses being built and a leveraging up. High prices didn't cure high prices. High prices remained until the conditions changed. So I'm just thinking about these things, and obviously speaking to everyone about them. And they're just thoughts. Doesn't mean they're right or wrong. I'm just trying to throw ideas out there, and I'm reading some replies. So the proper action, when theory and practice diverge, the theory and practice aren't diverging. Uranium is still the best bet, irrespective of what the price is. Uranium is an incredible bet irrespective of what the market in the short term is telling you, because the thing that tells you what is good is the valuation. And the valuation doesn't change with the pricing of the asset. So when people think, oh, well, this isn't working, you have to find out what your time frame is. If your time frame is 6 months, then nothing will work for you, because 6 months, you're not really investing off of fundamentals. You're investing off of the emotions and whims of whatever the market's going to throw at you. So you're not even investing. You're just gambling at that point. And here's one. It says, yeah, why use a 6 or 7% stop when you can take a 60% haircut? If you're in the volatile companies, you're going to just lose 7% of your money on every position you put in, because you can't get within 6 or 7% of every single, we'll call it origination of the position. That means that that would have to make you the most incredible market timer ever to get within 6% of the bottom of every single movement. If you're in a company that has daily swings of 10 or 20%, you're going to get stopped out of everything at a 7% loss. When I rode SM Energy and I bought it at a pretty good price, I bought it at $1.50. The stock did trade down a little bit after that. A 6% loss. So if I got in at $1.50 times 0.06 means I have a 9 cents move. And if you look, I think the stock got down below a 6% loss on that. And I had a really good entry point. And if you had had a stop loss at 6 or 7% and you got stopped out, you missed out on a 26 bagger or 25 bagger or whatever it is. 25 times your money in a year, or a little over a year. Yeah, that's a really smart move to put that 6% stop loss on that. That's why I don't use stop losses. I use position sizing to limit my risk, not stop losses. Because if you go into these highly volatile companies, you could see a 6 or 7% loss in the single day that you bought it. You just bought it at the wrong time of the day. So I don't think that's why we cost average in, and that's why we do that. And everyone talks about the losses. If you're in the general vicinity of buying in a low, you're going to have 1,000% gains, 10,000% gains at some point, possibly. But 1,000% gains, 10 baggers, you're going to get quite frequently. Getting within our 6 or 7% of that bottom, I would say, is probably almost impossible. I mean, obviously some people do it because every stock is going to bottom and turn up at some point. But to get every position within 6% of the bottom, I would say that's a very highly unlikely. All you're going to do is walk away with 6 or 7% losses on every single trade or investment that you put on. That's kind of how I look at it. Here's one. It says, like it or not, uranium will be a part of the bridge to whatever energy future awaits us. People don't like to starve in the cold. Thank you, Andy, for communicating so clearly. Yeah, I've got some articles, and I'll share those articles here, maybe after this clip. And a lot of people are banking on solar and wind to be our savior, but all the best spots in the world are already taken and filled up with wind and solar. So we're going to be going after lower and lower returning areas with solar and wind, and we are going to litter the entire world with this stuff. In order to generate enough power, I mean, I think it's going to take something like almost the size of Texas with solar panels. I mean, a very large amount of area is going to be taken with solar panels. And I don't know where they're going to put these things. It's going to take copious amounts of copper to connect it all together. So I don't think I think you're going to have mineral shortages and it's not going to go through. And what that means is that you're going to be burning fossil fuels or uranium or something else in the meantime. And you're probably going to see these large disconnections in price, because what's happening is your usage to storage ratio. So as your usage goes way up, the more renewables that you put in and the more unstable the grid gets, it means that you're going to be running and relying on natural gas more and more because they're putting natural gas power plants in place of the coal power plants for the majority of the plants. They run everything to this hub of the natural gas plant, convert it of the renewables, and probably send it through, I think it's AC power. They generate using direct current power. And when they're not generating it, they're running natural gas overtime. But if you're running everything on natural gas on overtime, that means that your usage of natural gas per year, per whatever time frame you want to measure it on, your usage is going up, but your inventory, your storages may not increase that much of where they're storing all this stuff. So depending on how that ratio grows, and maybe that's something we can look into, is your natural gas usage in relationship to how much inventory you have. And as your inventory shrinks and shrinks and shrinks in relationship to your usage, you have a higher likelihood of greater and greater price spikes. You're throwing more volatility into the system as your usage to inventory storage becomes more out of balance. And then your system and your demand is more out of balance. So you're getting larger and larger imbalances in the system. And it doesn't seem like that would be a great, more robust system for everyone. A large, unstable power generation source is not something that's highly desired. So when I say we're going to be burning natural gas in greater quantities and we're going to be using uranium in greater quantities, I speak like that as a survival. In order for humans to progress forward and survive, we must burn more fossil fuels and uranium for stable power generation. That's what an advanced society, in my opinion, requires. You can't have power outages every couple of hours. You can't build anything that way. You can't run your manufacturing facilities on that. You can't generate more gross domestic product per person, per capita, with an unstable energy grid. And you think dumping a whole bunch of, the whole thing that they're trying to implement just doesn't make any sense to me. So you're going to put all these renewables on, you're going to run natural gas, and everything becomes far more unstable. And at the same time, you're going to dump electric vehicles all on the power grid. So your demand's going to go through the roof, and then you're going to make everything more unstable. That doesn't make sense. Isn't stability the cornerstone of like everything? Stability is the cornerstone of a happy person. That's why, like, psychologically, you need to like ground yourself to something. A stable relationship is better than one that's all over the place. Stable work is better than no work at all, and then a whole bunch of work and then no work at all. A lot of people thrive off stability. And I think that's the same for anything that's an input to something as important as manufacturing facilities that generate wealth for their people. And yeah, I was just looking at all these things. If the dollar is so strong, why is bacon $10 a pack? Well, I'm not saying the dollar is necessarily outright strong against physical items, but money flows where the currencies and assets priced in those currencies are the strongest, because you get a currency exchange gain and you're protected by the asset that you invest in. So dollar-denominated assets outperform when the dollar is strong. Emerging markets and other currencies do well when the dollar is weak and their currencies are strong because people are going to put more money in those other currencies. So now you're playing currency exchange rates on top of where the assets exist. It has nothing to do about the assets. Everything to do about currency exchanges, interest rates, and inflation. It's all financialized. Everything. And I wrote that it's all about money flows. And I know I've got a lot of people that are giving me a lot of really good suggestions, but I'm gonna challenge some of your guys' things. It says I would like a spreadsheet or list of the companies with some of the info in the videos names of the companies with symbols, as I cannot see the symbols. That's great because you can see the symbols. But someone was saying like a whole bunch of fundamentals or the background of the company, and sometimes companies that look really good on paper don't perform as well as others, and it's really, it's like an art form to, well, one, you have to be able to price assets. Two, you identify market conditions of when the money's going to rotate into those assets. And then three, you have to find vehicles or things to invest in to ride higher. And it's an art form to translate performance and gains into into a good investment vehicle. To get good performance doesn't necessarily mean that you have to invest in good fundamental companies per se sometimes. Sometimes the fundamentals of those companies look the worst at the bottom, and that's how you get the best deal. Because those that look the worst are the ones that get sold off the most, but as the commodity price goes up and changes, their fundamentals change the quickest. They change the most from the worst looking balance sheet to a balance sheet that looks pretty good. And if you go from a negative to a positive, you can't divide by zero. Your return is infinite. But if you have a company that's a low-cost producer already making money, in an environment where the commodity price goes gangbusters, those usually go up the least amount. And if they're in production, they're already, I mean, remember, in a commodity company, you only have so much stuff in the ground. They're already draining their asset out of the ground and converting it to cash or dollars. So it's there's a huge art form there, and I don't know if it's as easy as what most people think, because they think that you just invest money in the best balance sheet and it's going to be the best performer. And what it turns out is they're usually the worst performers. The one that everyone thought was going to go bankrupt, that ended up didn't going bankrupt and started making, good money when the commodity price went way up, is the one that goes up the most. The high cost producer with a bunch of debt that everybody sold off to pennies on the dollar. And it's hard to, it's not easy sometimes. And remember, guys, the short-term movements are the hardest ones to predict. It doesn't mean that the thesis is wrong if you get a big pullback in any of these commodity stocks. And you can have cyclical movements in secular markets. Cyclical could be a down year inside of a very large upswing. So sometimes you have to be very patient. And I know a lot of people, they think they can time all this stuff. They think they can catch the bottoms. They think they can time it. And if you can do that, I mean, you should be a multi-millionaire in no time. I think that's why you don't see a lot of very wealthy traders. They don't exist. All of the really wealthy people are ones that buy large stakes in companies at are perceivably very good times and ride that entire big move. They're not trading in and out. They're buying 20% positions in companies when they're down and cheap, and then they hold on for the entire bull market and sell them at the top. They don't trade in and out. And I don't know of many traders who are trading for a couple months hold that are extremely wealthy, because you just can't move that amount of money that fast either. It says, but no one is saying we should use 70% of energy with solar panels by 2035. We got nuclear energy, wind energy, hydro energy, natural gas energy. No, if they wanted to go to a zero emissions future in that article, they said that they want to generate 70% of their power by solar or photovoltaics by 2035. That's what they wanted in the article. It's not me. And that one person is saying that they should use 70% of the energy with solar panels to get to a net zero. You can't use natural gas in a net zero area. And maybe you meant something differently by that reply. And their natural gas went way up today. It was up 38% just today in one day. I know, it's crazy. I'm a big natural gas bull. Like I think natural gas is going to be, and oil. Oil is going to go way higher. They're the premium fuels. They have the highest energy return on investments. along with uranium, and that's what gets you the energy to do work in society. You put these lower ones in, you're not going to get the work into society like these other ones can. So, and remember, guys, we are growing at exponential speeds. Exponential speeds requires exponential energy growth. Exponential energy growth with something that is really mineral intensive will exponentially eat through your minerals. So you won't have any minerals left. And if the energy required to get the minerals out of the ground goes up exponentially as the ore grades decline, you're going to find yourself in a catch-22 where the very power that is needed is going to be put back into getting more power. And that's eventually what happens is all the power that's being generated is going back to get the minerals to generate more power. You have no more power to put into society in that type of environment. And I'm not saying that we're necessarily there yet, but who knows? If we're growing exponentially, I mean, we're going to run into, I think, constraints somewhere. So I'll stop it there, guys. This is getting kind of long. If you guys like this content, give me a thumbs up. Subscribe to the channel if you haven't already. And thank you for listening. This is Finding Value.